Welcome to this educational video on sustainable investing and ESG factors in finance. ESG stands for environmental, social, and governance. These three pillars represent a modern approach to investing that goes beyond traditional financial metrics. Throughout this video, you'll learn how environmental considerations, social responsibility, and corporate governance play crucial roles in making informed investment decisions. This knowledge will help you understand how investors can align their financial goals with positive societal impact. ESG investing is an investment approach that considers environmental, social, and governance factors alongside traditional financial metrics when evaluating companies and investments. Rather than focusing solely on profit margins and revenue growth, ESG investing integrates sustainability and ethical considerations into the decision-making process. The goal is twofold: to generate long-term competitive financial returns while simultaneously promoting positive societal impact. This approach recognizes that companies with strong ESG practices often demonstrate better risk management and resilience over time. Environmental factors examine how a company interacts with the natural world. Carbon emissions measure a company's greenhouse gas footprint and the initiatives they take to address climate impact. Resource management evaluates how efficiently a company uses energy, water, and raw materials in its operations. Waste and pollution focus on the strategies companies employ to reduce waste and control pollution. Finally, biodiversity considers the company's impact on ecosystems and their efforts toward wildlife conservation. Companies with strong environmental practices tend to be better prepared for regulatory changes and resource scarcity. Social factors assess how a company manages relationships with employees, suppliers, customers, and communities. Labor practices examine whether companies provide fair wages, safe working conditions, and protect employee rights. Diversity and inclusion measure workplace equality and representation across different demographics. Community relations look at how companies engage with local communities and create positive social impact. Human rights evaluate supply chain ethics and compliance with human rights standards. Companies that excel in social factors often experience better employee retention, customer loyalty, and brand reputation. Governance factors focus on how a company is run and the quality of its leadership. Board structure examines the presence of independent directors, board diversity, and overall composition quality. Executive pay assesses whether compensation is fair and aligned with long-term company performance rather than short-term gains. Transparency evaluates disclosure practices and the integrity of financial reporting. Ethics and compliance measure anti-corruption measures and overall ethical business conduct. Strong governance reduces the risk of scandals, mismanagement, and regulatory violations that can devastate shareholder value. ESG matters for investors for three key reasons. First, risk management. ESG analysis identifies potential risks that traditional financial analysis might overlook, such as environmental liabilities or governance failures. Second, long-term performance. Research shows that companies with strong ESG practices often demonstrate better financial resilience and stability over extended periods. Third, values alignment. ESG investing allows individuals to invest in companies that align with their personal values and ethical standards. Investors no longer have to choose between doing good and doing well financially. There are four main approaches to ESG investing. Negative screening involves excluding companies or entire industries that don't meet ESG standards, such as tobacco, weapons, or fossil fuels. Positive screening actively selects companies with strong ESG performance and leadership in sustainability. ESG integration incorporates ESG factors into traditional financial analysis and investment decisions, treating them as material financial risks and opportunities. Active ownership engages with companies to improve their ESG practices through shareholder dialogue, proxy voting, and other forms of influence. Investors can choose one or combine multiple approaches. Multiple agencies provide ESG scores to help investors evaluate companies systematically. MSCI ESG ratings use a scale from AAA to CCC based on how well companies manage ESG risks and opportunities relative to industry peers. Sustainalytics provides risk-based ratings that measure the degree to which a company's economic value is at risk due to ESG factors. FTSE Russell offers ratings from 0 to 5, evaluating both ESG practices and the quality of disclosure. While these ratings provide valuable frameworks, investors should be aware that different agencies may rate the same company differently due to varying methodologies. ESG investing faces several important challenges. The lack of standardization means there are no universal ESG measurement standards, and ratings can vary significantly between agencies, making comparisons difficult. Greenwashing risk occurs when companies overstate their sustainability efforts without genuine commitment or meaningful action. Data quality issues arise from inconsistent reporting practices and limited disclosure from some companies, particularly in emerging markets. These challenges require investors to conduct thorough due diligence and not rely solely on ESG ratings when making investment decisions. Let's recap the key takeaways from this video. First, ESG investing integrates environmental, social, and governance factors with traditional financial analysis to provide a more complete picture of investment opportunities. Second, strong ESG practices can indicate better risk management and potentially lead to superior long-term performance. Third, multiple investment approaches exist, ranging from negative screening to active engagement, allowing investors to choose strategies that match their goals. Fourth, challenges including standardization issues and greenwashing risks require careful evaluation and ongoing vigilance. ESG investing represents a growing movement toward more sustainable and responsible capitalism.
If you like this video, hit that like button and don't forget to subscribe. Visit CodeLucky.com for more such useful content.